The trend is your friend is one of the most repeated rules in trading. It's also incomplete advice. A stock can be in a clear uptrend on the daily time frame while simultaneously in a clear downtrend on the 4-hour. Which trend is your friend? The rule doesn't say. Most traders default to the time frame they happen to be looking at and end up fighting the higher time frame without realizing it. Today, why time frame specification matters, the top-down framework that aligns entries with the higher time frame trend, and how Confluence across time frames turns the famous rule into actual edge. Here's the framework pros use. Top-down. The weekly chart tells you the long-term regime, bull or bear, accumulation or distribution. The daily chart tells you the trend within that regime, which direction the swing is going. The 4-hour chart tells you when to enter, the pullback, the consolidation, the trigger candle. The hourly or 15-minute chart is execution, the actual entry. Each time frame answers a different question. Mixing them or only looking at one produces contradictions and bad trades. Watch this in a synthetic chart. The 4-hour shows a clean uptrend, higher highs, higher lows for 30 bars. A trader sees the 4-hour and buys, telling themselves they're with the trend. What they didn't check, the daily is in a confirmed downtrend and the 4-hour rally is just a counter-trend bounce within the bigger move. When the daily resumes its direction, the 4-hour trend breaks down violently. The trader was with the trend they were looking at, but against the trend that actually matters. Here's the rule that solves it. The higher time frame wins ties. When the daily and the 4-hour disagree, you trade the daily direction and use the 4-hour for entry timing within that direction. When the daily and the 4-hour agree, you have confluence and the trade is high probability. When the daily is unclear, you stand aside. Don't force trades when the dominant time frame is muddled. The rule reads as align with the highest time frame that has a clear trend, then use the lower time frames to time entries. Now the aligned setup. Daily, clear uptrend, higher highs, higher lows. 4-hour, pullback to a daily support level beginning to base. The trader checks both, alignment confirmed. Enters on the 4-hour trigger candle that bounces from the daily level, places stop below the 4-hour swing low, targets the next daily resistance. Both time frames pointing up, entry timed on the lower time frame, risk managed within the higher time frame structure. This is the trend trade the famous rule was always trying to describe. On a real workflow, open 3 charts before every trade. Weekly, regime check. Daily, trend direction. 4-hour, entry pattern. If the 3 line up, take the trade. If they conflict, either stand aside or trade the lower time frame move as a quick counter-trend scalp with tighter management. The discipline of opening 3 charts instead of 1 filters out most of the bad trades automatically. The trend really is your friend when you specify which one. So the trend is your friend is incomplete advice without time frame specification. The higher time frame wins ties, align entries within the higher time frame trend, stand aside when time frames conflict and the higher one is unclear. 3 charts before every trade, that's the workflow that turns the famous rule into a real edge. Subscribe for the full method and trade your own plan. Education, not financial advice.